What if the biggest improvement you could make to your trading wasn't finding better trades? What if it was learning when not to trade? Because here's the uncomfortable truth. Most traders don't lose money because they couldn't find opportunities. They lose money because they couldn't stop themselves from taking them. You open your charts, you see a small move, then another, then another. Suddenly, you've been staring at the market for 2 hours and your brain is screaming, "Take something." So you do. Not because your setup appeared, because you got bored. That's the beginning of the problem. Trading creates a strange illusion. The more time you spend looking at charts, the more you feel like you should be trading. But watching the market doesn't create an obligation to participate. A professional trader can spend an entire session doing nothing and still have a successful day. That's because they understand something beginners usually learn the expensive way. An opportunity and a trade are not the same thing. A chart can look interesting without being worth your risk. So I decided to build a simple system with one job: not finding trades, rejecting them. Every setup would have to pass through a filter before I could even consider entering. And the filter would ask 5 questions. Is the market actually trending? Is there enough liquidity? Is the entry at a meaningful level? Is the risk to reward worth taking? And most importantly, is there a reason I should stay out? That final question changes everything, because most traders look for reasons to enter. Professionals also look for reasons not to. And when I started testing this idea on my own setup, something became very obvious. Some of the trades I felt most excited about were exactly the trades the filter wanted me to avoid. And that raised a much bigger question. Could avoiding bad trades actually make a trader more profitable than finding better entries? That's what I wanted to test. So I created the no trade filter. And the first rule was brutally simple. If the setup doesn't pass the checklist, there is no trade. No exceptions. No. But this one looks really good. No revenge trade, no FOMO, no changing the rules after seeing the candle move. If it fails, it fails. And the first test was about to reveal just how many trades I was taking that never deserved my money. The first thing I discovered was uncomfortable. I was taking trades because they existed, not because they were good. That's a huge difference. So I started tracking every setup before entering. No screenshots after the trade, no hindsight. The decision had to be recorded before I knew what would happen. The first question was market condition. Is the market trending, ranging, or completely chaotic? Because the same strategy can behave completely differently depending on the environment. A breakout strategy and a strong trend might make sense. The exact same breakout inside a messy range can become a trap. So the filter gave market condition a score. Then came liquidity. Where are traders likely to have their stops? Where did price previously react? Is there actually a reason for price to reach the level I'm watching? If I couldn't answer that question, the setup lost points. Next was entry quality, not, can I enter here? But why here? That's a much harder question. Because almost anywhere can become an entry if you're desperate enough. Then came risk to reward. This was where a lot of beautiful looking trades died. A perfect setup with terrible risk to reward is still a terrible trade. Imagine risking $100 to potentially make $50. You could be very good at predicting direction and still create a bad business model. So the filter started rejecting those setups. Finally came the question most traders don't want to answer. What could make this trade fail? Major economic event, extreme volatility, poor liquidity, chasing price, entering after the move already happened? If the answer was yes, the trade was downgraded. And suddenly I had something I never had before. A reason to stay out. That sounds simple, but psychologically it's huge. Because once you've decided to trade, your brain starts looking for confirmation. You want the trade to happen. You want the chart to agree with you. The filter doesn't care. It doesn't know how badly you want the trade. It only knows whether the conditions are there. So I created 3 categories: A setups, B setups, and no trade setups. A setups met the rules. B setups were interesting but incomplete. No trade setups had a reason to stay out. And I made one rule that completely changed the experiment. B setups were not allowed to become A setups just because I wanted them to. The market had to change, not my opinion. That one rule removed a huge amount of emotional decision-making. But now I needed to know whether the filter actually worked. So I went back through historical charts, and I tested the setups one by one. No hindsight, no skipping losers, no choosing only the examples that made the system look good. And the first result wasn't what I expected. The filter wasn't finding more winners, it was removing something else. Something much more dangerous: bad trades. Now came the part that actually mattered: testing. Because a trading system can sound incredible until real charts start exposing its weaknesses. So I went back through historical data, one setup at a time, and I followed one rule. I wasn't allowed to change the rules after seeing the outcome. That sounds obvious, but it's one of the biggest problems with backtesting. People see what happened first and then build the explanation. I wanted the opposite. The decision had to come first. The outcome came second. So I started with 100 setups. Some were winners, some were losers, and some never should have been trades in the first place. The filter had one job: separate them. And the results were surprising. The system didn't magically turn every setup into a winner. It did something much more useful. It removed a huge number of low-quality decisions, and that matters more than people think. Imagine you have 100 trades. You don't need every trade to be amazing. You need to stop taking the trades that repeatedly damage your account. That's where the system started becoming interesting. I found setups that looked almost identical on the chart. Same pattern, same entry style, same direction, but completely different outcomes. The difference was the environment. One happened during clean market conditions. The other happened right before major economic news. Visually, they looked similar. Contextually, they weren't. That's why a strategy can't exist in isolation. A setup doesn't have the same probability in every environment. And this is where AI can become useful, not as a crystal ball, as a context machine. You can give it information that would take a human trader several minutes to organize. Market structure, volatility, session, economic calendar, recent price behavior, risk to reward, previous performance of similar setups. Then ask one simple question: does this setup meet my predefined rules? Not, will this trade win? That's the difference between analysis and prediction. So I added another layer. The AI had to explain every rejection. If it said, do not trade, it had to tell me why. Maybe the market was ranging. Maybe the entry was too late. Maybe the stop was too wide. Maybe the reward wasn't large enough. Maybe a major event was approaching. And this created something extremely valuable. A trading journal that could actually talk back. Instead of writing, I lost this trade, L could ask, why did I keep taking this type of trade? That question produces a completely different kind of learning. And then I found the most important pattern in the entire experiment. My biggest losses weren't coming from the strategy. They were coming from trades where I had already broken the process. Late entries, FOMO, revenge trades, moving stops, ignoring conditions. The chart wasn't the problem. The decision before the chart was. That's when the no-trade filter stopped being just a trading tool. It became a behavioral firewall. Its job wasn't to make me more aggressive. It was to make impulsive decisions harder. But historical testing still wasn't enough. Because there is one thing a backtest can never fully reproduce: the feeling of watching real money move against you. So the next test had to be different. No hindsight, no perfect screenshots, no knowing what happens next, just live setups and the same rules. And that's where the system was about to face its biggest challenge. Because the first live setup looked perfect. The kind of setup that makes a trader want to click buy before the analysis is even finished. But the filter said no trade. The setup looked perfect. Clean structure, strong momentum. Liquidity right where I wanted it. The risk to reward was excellent. If I were trading without the filter, I would have entered almost immediately. But the system said no trade, so I stopped. And this is where the experiment became psychological. Because knowing you shouldn't trade is easy. Watching the market move exactly where you predicted without you is much harder. Price started moving in the direction I expected. 5 minutes, then 10, then 20. My brain started screaming the same thing every trader has heard before. I knew it. See? I should have taken it. This is where FOMO begins. And FOMO doesn't always happen before a trade. Sometimes it happens after you correctly predicted a move you didn't participate in. That's dangerous, because now your brain wants revenge. It wants to catch the next move. So another setup appears. It isn't perfect, but it looks close enough. Normally, I'd convince myself that it was worth taking. The filter said no trade again. This time I listened. And then the market reversed. The setup failed. That single moment taught me more than any winning trade could have. Because I realized something. A no-trade decision doesn't have to look intelligent immediately. Sometimes the market will move without you. Sometimes you will watch a setup you rejected become a winner. That's normal. The goal isn't to capture every profitable move. That's impossible. The goal is to make high-quality decisions over a large number of opportunities. This is where probability enters the picture. Imagine your strategy has a genuine edge, but you only take the trades that meet your strongest conditions. You might take fewer trades, but each decision has a clearer reason behind it. That's very different from taking every setup that looks attractive. And then I added something even more important. A daily loss limit. Not because the AI told me to, because no system deserves unlimited access to your capital. The rule was simple. If I reached my predefined daily loss limit, trading stopped. Completely. Even if the next setup looked perfect. even if I was convinced it would win, even if I wanted to make the money back. The day was over. This rule wasn't designed to maximize profits. It was designed to prevent one bad emotional session from becoming a catastrophic week. Then I added another rule. After every trade, the system would ask me 3 questions. Did I follow the plan? Did I respect the risk? Did I enter for the reason I originally defined? If the answer was no, the trade was marked as a process failure, not a strategy failure. That's an important distinction, because if you lose while following your system, you gain information. If you lose because you ignored your system, you gain a lesson. But if you keep making the same mistake, you aren't learning. You're paying tuition without attending the class, and that's exactly what I wanted the AI to catch. Patterns in my behavior that I couldn't see while I was inside the trade. After enough data, the system started identifying my personal weaknesses. Certain sessions where I overtraded, certain setups where I entered late, certain losses that were almost always preceded by another loss. That was the real breakthrough. The AI wasn't predicting price, it was predicting my behavior. And suddenly the question changed. Instead of asking, what will the market do? I started asking, what am I likely to do wrong? That question was far more useful. But there was still one final problem. A filter can tell you when not to trade. It can help control your risk. It can expose your patterns. But eventually you still have to press the button, and the final test was going to determine whether this system actually made me a better trader or simply a trader with a very sophisticated excuse not to trade. After everything I tested, I came to a conclusion I didn't expect. The best part of the system wasn't the AI. It wasn't the scoring model. It wasn't the market analysis. It was the ability to do nothing. That sounds ridiculous until you realize how much money traders lose trying to force something to happen. The market doesn't owe you a trade today. It doesn't care that you woke up early. It doesn't care that you have a target for the month. It doesn't care that you lost yesterday and want your money back. The market only gives you conditions. Your job is to decide whether those conditions deserve your risk. That's the entire idea behind the system. And if you want to build something similar, you don't need a billion-dollar hedge fund. You don't even need a complicated AI. Start with a simple checklist. Before every trade, ask yourself 5 questions. Is the market in a condition where my strategy actually works? Is there a clear reason for the entry? Is the stop loss at a logical invalidation point? Is the potential reward large enough to justify the risk? And finally, what is the strongest reason not to take this trade? If you can't answer those questions, you don't have a trade yet. You have an idea, and an idea isn't enough to risk money. Then add one more layer. Track everything. Your entries, your exits, your risk, your setup type, your session, your mistakes, and especially the trades you wanted to take but didn't. Because those trades can teach you something important. Sometimes the best decision you make will look like nothing happened. You won't get a winning screenshot. You won't get a huge green candle. You won't feel like a genius. You'll simply close the laptop and keep your capital, and that's okay. Because trading isn't about being involved in every move. It's about being involved when the odds justify the risk. That's where AI can become extremely useful. Not as a magical predictor. Not as a machine that prints money. But as a second brain. Something that forces you to slow down. Questions your assumptions. Finds patterns in your journal. Calculates risk. Checks conditions. And tells you something traders rarely want to hear. Don't trade. But there's one final rule L would never break. Never give the AI complete control of your money. An AI model can be wrong. Data can be wrong. The analysis can be wrong. The market can do something nobody expected. So use AI to improve your decision-making. Don't use it as an excuse to stop thinking. Because the goal isn't to build a machine that trades instead of you. The goal is to become a trader who makes fewer stupid decisions. And that is a much more realistic use of AI. So the next time you open your charts, don't immediately ask, where should I enter? Ask something more important. Does this trade actually deserve my money? If the answer is yes, execute the plan. If the answer is no, close the chart, walk away, and let the market keep moving without you. Because there will always be another setup. There will not always be another account. That is the system. Not predicting everything. Not trading everything. Just protecting your capital until the right opportunity finally appears. And sometimes the smartest trade you'll ever make is the one you never take.